guys, it's me Vedant, and in this video we are going to talk about the differences between trading and investing and possibly figure out which one suits you better. There is never just one way of accomplishing a task, and the same applies even in the stock market. Trading and investing are two very different ways, but they can both help you make money in the stock market. Let's understand what each one of them are and then understand the differences. Let's start off with trading. Trading involves buying and selling shares in relatively shorter spans of time, sometimes weeks, months, days, or even hours. There are many ways of trading, but something common to most of them is technical analysis. Technical analysis is the method or the mechanism using which most of the trading is done. Technical analysis works on the logic that history repeats itself, meaning there are certain patterns that have been observed in the short term that have appeared many times, and using these we make some predictions for the future. However, there are at times when you strongly expect a pattern to follow and that doesn't happen. Trading is extremely attractive because of its potential to earn quick money, but we have to understand that it comes with a lot of risk attached to it as well. It is said that less than 5 to 10% of traders really make money on a consistent basis. The key word here is consistent. Just because you bought a stock and it magically doubles within 2-3 months because of luck doesn't mean you become a successful trader. Such instances can give us a false sense of confidence to make us more reckless and make losses in the future. Trading is a learnable skill, but when done without knowledge and proper risk management, it becomes identical to gambling. When I say improper risk management, I mean buying stocks based on random tips you get. If you are interested in exploring trading, it's better to first equip yourself with knowledge and then experiment with smaller amounts, because you will make mistakes in your learning phase while you figure out whether it is for you or not. Trading requires a very active participation in terms of following the market and news. You must be capable of thinking rationally in the face of lot of volatility as well. If we understood that, we can completely make sense why algorithmic trading has become so hot. After all, a computer can think more rationally and find patterns better than a human being. It can be extremely difficult for us to think rationally when we are being bombarded with so much news, but it's not the same case for a computer. Trading is done using tools such as candlesticks, RSI, Bollinger Bands, and many more parameters, which are out of the scope of this video. There are 3 things that a trader must keep in mind before entering into a trade. They are stop loss, duration of trade, and target price. Let's understand that with an example. Let's suppose you went into a trade with 100 rupees. Your stop loss must be, suppose, 90 rupees, meaning if the stock goes below 90 rupees or hits 90 rupees, you will exit the trade because the plan is gone wrong and you need to accept the defeat and come out of it before incurring more loss. Well, you must have a somewhat decent idea of how long the trade is going to be, whether it is 1 day long, 1 week long, 1 month long, couple of months long. You must have some idea in your mind, because if suppose I am a day trader, I buy and sell stock within the same day, but then it turns out that I'm going to make a loss if I sell it within the same day, then I postpone it to the next day. And when I do that, what I'm doing is I'm indirectly becoming slowly a long-term investor in a stock that I actually was interested in trading. This is a big mistake that majority of the traders make. Well, if you're a trader, you cannot keep your money tied up in bad decisions like that and become a long-term investor. You have limited resources and you want to be consistently generating a return when you're a trader. You don't want to keep your money tied up in bad decisions like that. A person who can correctly predict 7 to 8 trades out of 10 is considered to be a skilled trader because he has a somewhat sustainable model figured out. Well, the third was target price. Well, that is pretty much self-explanatory. You must have a good idea of what price you would be willing to sell at after you have bought it for suppose 100. If you do not have a clear picture like this, there's a high chance of you behaving recklessly like we discussed before. Okay, now let's come to investing. Well, investing involves longer spans of time, 3 to 5 years or even more. Investing is done with the help of fundamental analysis. Well, the fundamentals that are analyzed are financials, the management, the people who are running the company, the business model, having an overview of the industry the company is working in, understanding its competitive advantages, and so on. Something we must acknowledge is that a stock represents a company, a business. It is not a lottery ticket. Most of the people who made staggering sums of money have generated most of their wealth through investing. What they do is they find a company in their early stages and stay invested in it for 10-15 years and be part of their growth or success story. That is how most investors make huge sums of money. For example, Rakesh Jhunjhunwala, a man who is also known as the Indian Warren Buffett, has made a fortune from the company known as Titan, the watch company. He invested it in its early stages and now he is reaping the benefits of compounding. We must remember that stock market at the end of the day works on compounding, and considering that majority of the people watching this video are between 18 and 24, it's a privilege that you still have of making use of compounding as you're still young. So make sure you make use of this. Especially for common people like you and me, investing is much more sustainable and also can generate larger sums of money as compared to trading. Now, mind you, investing does come with its own risks. Just because you bought a random stock and held on to it for a few years does not ensure profits. We need to build a portfolio of multiple stocks to get exposure in different sectors and also dissipate our risk. The same logic as never put all your eggs in one basket. If you are capable of doing fundamental analysis, then you could try your hand at stock picking and constructing a portfolio for yourself. However, if that is not the case, you're better off investing through funds such as that of Nifty. It turns out that various mutual fund managers often struggle beating even the Nifty, and this is a phenomenon that happens globally. It is very difficult for fund managers often to beat the index or the market. We are speaking over longer spans of time such as 10 years. We will delve into the reason for that in some other video. Considering most of you are young, and if you are looking at investing, you should also look at mid-cap and small-cap funds, as they have a stronger chance of beating the market or the Nifty over long spans of time. Please never keep the mindset that trading or investing are easy. We study for 22, 24, even 26 years at times before we start earning. Then how could you assume this to be easy? It is this mindset that makes majority lose money and stock market often taboo. Trading and investing both need a lot of time to be dedicated into learning, and both need discipline as well. I used to be extremely biased towards investing because I used to watch so many videos of Warren Buffett, Peter Lynch, Charlie Munger, and many more massive investors. But I also came across something very interesting. It is that Rakesh Jhunjhunwala, Radhakrishnan Damani, some of the people who have generated massive returns in India started off as traders. Having some knowledge of technical analysis can come in very handy even when investing, because it can actually help you take the decision of when to buy the stock, even if it's for a long period of time. So therefore try to learn both of them, but I would strongly suggest first learn fundamental analysis and then go to technical analysis, because you must know what a stock, what a company really means before you actually go and buy it. And especially when you're just starting out, trading off the bat is almost like gambling, and it's extremely dangerous if you're doing it not even from your own money but your parents. I tried my best to give you both stories here, but like I said, I am a little more biased towards investing, but that is for good reason. Therefore, I will suggest you understand both of them and then choose for yourself which one is better for you. I tried to inform you in a responsible way, not influencing you too much from my own biases, but also cautioning you. Also, let me know in the comments which one you prefer, trading or investing. That's it for this video, guys. Make sure to smash that like button and subscribe if you haven't already.